Welcome to the Barometer Readings Monthly Conference Call. My name is Joe, and I will be your operator for today's call. At this time, all participants are in a listen-only mode, and later we will conduct a question-and-answer session. Please note that this conference is being recorded. I will now turn the call over to Mr. Nick Hamilton. Mr. Hamilton, you may begin.
Thanks, operator. Hi, everyone. Welcome to the Barometer Readings conference call, our monthly forum to communicate and provide transparency on what we're seeing and how we're positioning our investors. So we're most of the way through 2013, and we've got a few observations already to characterize the year. Firstly, flexibility for an income manager has been key in 2013. This would be true flexibility of mandate, asset allocation, geography, as well as having the nimbleness to conduct these changes quickly. We've seen the market consolidate a few times this year, which has allowed for portfolio repositioning and new areas of focus. We've seen income assets undergo a sorting process, but behavior of sectors with slightly more economic sensitivity remain much stronger than those with interest rate sensitivity. And it's worth noting that this is very different from a year ago, and we spent some time highlighting this on previous calls. Flexibility and following market leadership has also yielded stronger results. Q4 performance so far has been quite strong, with many of these new areas of focus starting to work out very well. So let's review some of our mandate year-to-date performance as of yesterday. So the Barometer High Income Pool, year-to-date performance of about 7.7%. Barometer Global Tactical Balanced, 8.8%. Barometer Tactical Exchange Traded Pool, 9.8%. Barometer Income Advantage Fund, 11.3%. Barometer Global Equity Pool, 11.8%, actually with 4% in the last week, so some good pickup there. Barometer Equity Pool, 23.6%. And lastly, Barometer Long Short Equity, 25.14%. So we're quite pleased with those results. At this point, I'll turn over the call to David Burrows, our President and Chief Investment Strategist. We'll talk a bit more about how these results have been achieved this year, our leadership models, positioning, and our outlook.
Great. Thanks, Nick. Really what I thought I'd do is sort of take it from the top and talk through what we're seeing from a breadth perspective market-wise, where money is getting put to work, what may be supporting the behavior that we're seeing, talk a little bit about where the pools and funds are invested and what it looks like going forward. So just from a broad perspective, if we take a look at the equity asset class globally, slowly breadth is improving. So as of today, roughly 54% of stocks globally are in long-term upward price trends, in other words, behaving constructively. That percentage has been rising slowly over the last few months, meaning that money is getting put to work. As you can see, the way the market's been behaving recently, very small pullbacks, even on what has been some difficult news flow over the last couple of 3 months. Market really has not been able to sustain any kind of significant correction. It tells us that there is money under the surface looking to get positioned. So breadth globally is sitting at 54%. Why is that important to note? To be clear, long-term rallies don't tend to come to an end until you get to a point where 75-80% of stocks are participating. So at 54%, we're a long way from there. We're roughly midfield. And so I think that there is a tailwind for equities globally. If we look at the breakout geographically, developed markets have a broader-based rally than developing markets. The strongest markets globally from a breadth perspective would include the U.S., Germany, the U.K., and broad-based Europe. Canada would be in roughly midfield at about 54%. And at the other end of the spectrum, Shanghai, South Korea, Singapore, Thailand, Hong Kong all reside between 30 and 50%. So the developing countries have a less broad-based rally. It is a mixed bag. Many of those countries are not seeing improvement in breadth. The sort of high percentage odds of success continue to be in developed markets. When we look at it from a sector perspective, We talked on the last call about the rotation that's been going on through the year from interest rate proxies, things that are really specifically tied to interest rates, to things that have a little bit more economic sensitivity, let's call those early cyclicals. That continues to be the case. We continue to see strength in financials, technology, consumer discretionary, early industrials, and healthcare. And we've been doing a lot of fishing in those ponds. And in general, we look at the backdrop, there is good fundamental support for what's been going on. Fundamentally, we've talked about the equity risk premium, or the earnings yield on the S&P, for instance, versus the yield on a 10-year bond. Earnings yield on the S&P is just over 7% versus the yield on a 10-year at 2.8. There's a very strong, close to 4.5% equity risk premium that we're getting paid to own equity risk. So the two things that could move in that formula, one are the earnings, and two are the yield on a 10-year. From a yield, when we look at the yield on a 10-year bond, it looks to us to be range-bound between sort of 2.5% and 3%. The things that we think would need to happen to have a sustained move higher in yields of the 10-year, which would include a pickup in inflation, no sign of that. A pickup in employment growth, no sign of that. Average over the last 6 months, 180,000 jobs a month. Pickup in credit default swaps or credit risk, no sign of that. Or big acceleration in GDP, no sign of that. Ultimately, it does not look as though the conditions are in place to have a sustained move higher in long-term bond yields. From an earnings standpoint, we've been seeing some small improvements in earnings estimates. We came through the quarter with a roughly 5% earnings beat against expectations. That's a better earnings beat than the previous quarter, which was about a 2.5% beat. And profit margins remain healthy. When we look at the things that can drive inflation, certainly commodity prices continue to be weak, and we continue to avoid virtually all areas of the commodity market. We were looking at them this morning in the morning meeting, and whether you were looking at cotton or copper or grains or gold or the broad commodity indices themselves, like the Rogers Commodity Index, all are scraping along the bottom of the barrel and, in fact, look as though they want to go lower. The one holdout earlier in the year, crude oil, which arguably had a risk premium in it for what was going on in the Gulf when it was at 110, is a lot lower than that today, sitting now in the low 90s, and has been grinding its way lower. So from an inflation standpoint, I think things look quite good, and clearly the central banks are making it clear that they believe that that's the case with a rate cut in Europe. I think there's bigger concerns of disinflation than inflation. So we were looking at some interesting charts this week that I just thought maybe I would pass along and look at the type of market that we're in. When we try and understand what's working and why it's working, we try and look at previous markets for some guidance. It's interesting, if you look at the 1990s, through the 90s, you had steadily falling inflation. And through that period, the sectors that led the market were consumer, healthcare, and technology. It's not so much that earnings grew rapidly, but the PE that investors were willing to pay steadily expanded. In the decade of the 90s, in 8 of 10 years, PE multiple expanded for the market. So some earnings growth and PE multiple expansion gave very strong price performance. Through the 90s, in general, stock correlations moved lower. The beginning of the 90s with correlations close to 90%. The end of the 90s, correlations were down around 30%. So it became a stock picker's market over time. If you look at the decade from 2000 to 2010, 1 year of PE multiple expansion. And in general, the sectors that did well were those that are more linked to inflation, basic materials being a considerable force over that decade. What is interesting is that in the last 18 months, we once again are seeing PE multiple expansion in the market. We are seeing a resumption in the trend to lower inflation. We're seeing leadership from the sectors that tend to do well in a low inflation world, which include, financials, technology, consumer. and healthcare. And correlations have been falling. Last November, correlations were at 95%. Very hard to distinguish yourself against the herd. Over the course of this year, correlations have steadily been moving lower. PEs are moving higher. Correlations remain at 55%, so they still are elevated relative to where they got to in previous rallies. And breadth is steadily improving. So we think that we are in a fairly constructive market. Why is it that the consumer discretionary sector is doing well in sectors that relate to the consumer? If we look at the things that impact a consumer's spending ability, there's really two big factors. You've got debt servicing costs, which have been falling steadily as they've been refinancing their mortgages. And the second bucket would be food and energy, big components in CPI. Both of those sets of costs have been falling. Gasoline prices have just hit, again, the lowest price in about 30 months, and certainly food prices have been moderating. If you look at those two factors, it's interesting to find that the average consumer's free cash flow in the U.S. is at the highest level in 25 years. So cash flow is improving at the same time as the one component in CPI that is above 2%, housing, is supporting the wealth effect. So market's getting a little better, house prices getting a little bit better, costs for a consumer coming down makes it a more buoyant consumer. And certainly consumer discretionary is about the best sector in the market so far year to date. Consumer makes up 72% of the U.S. economy. It's not hard to understand why the U.S. stock market is performing so much better than other markets around the world. So in our portfolios, we've talked about the fact that equity asset class looks about the most attractive. We are focused in equities. When we look at geographic exposure in our equity portfolios, we are roughly 65% U.S., where the recovery is the furthest along and probably the most sustainable. We're about 5% Europe, where the recovery is earlier stage and arguably not quite as durable. And then we have about a 30% weight in the Canadian market in some very specific sectors. We believe that we are likely in the beginning of the next secular bull market for stocks, and that this rally has some legs. So we've spent the last 12 years really focusing on the high income strategy, which we continue to think is very well positioned. That portfolio is 85% equities. It is focused on lower payout but high dividend growth sectors and themes, and we think that plays directly into the demands of the baby boomer investor, where the front end of the baby boom is 60 years old and there's a demand for yield. That portfolio, we think, should be the core of any account, and we certainly use that in our business. But we are, for the first time in 12 years, really going back to push on clients to say, take a hard look at the equity strategy. Our equity strategy performs very well in a market where correlations are coming down. And clearly there are some sectors in this market that are not necessarily appropriate for an income portfolio, where there's a little bit more beta attached and where we have an opportunity to add some value, and we're certainly seeing that in the equity portfolios. So equity portfolio today is roughly weighted toward these sectors. Technology makes up 21% of the portfolio, and that would be a combination of software, semiconductor, and IT services, along with some internet software and services. Energy is about 20%. We've talked a lot about that over the last number of months, and again, these are just very targeted investments where, for the most part, these are producers that have hedges on their production, so their prices are set, and where they have strong policies around distributing cash flow back to investors. We have about 18% of the portfolio in consumer discretionary, which would include auto, leisure, and personal products, and media. Industrials make up about 12% of the portfolio. These are industrial companies that are benefiting from the low cost of energy in the U.S. And replacement cycle. 10% would be financials, and that's a split between Canada and the U.S., but it's across insurance, asset managers, and banks. And healthcare makes up about 7% of the portfolio, and that would be biotech and pharmaceutical largely. So this portfolio on the equity side is very focused in some clear leadership themes, which we think have legs. The income portfolio is positioned differently. Biggest weight in the portfolio would be financials, which is why we have more in Canada than we have in the equity portfolio. Roughly 33% of the portfolio would be financials, again made up of capital markets or asset managers, insurance, and commercial banks. Energy would be about 18%. And that's a combination of producers and services. Technology is about 10%, consumers about 7%. So you can see that the higher beta sectors make up a smaller component in this portfolio. Industrial is about 7%. And the only area that is more interest rate proxy would be REITs, and those would be industrial REITs that really specifically have greater likelihood of increased distributions because they are a little bit more economically sensitive. So as we move forward, so long as it looks as though inflation is muted, and certainly we're watching commodities and food and energy costs, as long as the interest rates remain in range bound, which it looks as though they are likely to do, we think that we are likely to continue to get PE expansion. Breadth models are supportive. Money is getting put to work. The equity risk premium is supportive. We think that is likely to continue to move money towards equities. We continue to be positive. From a geographic exposure standpoint, we continue to like developed markets as opposed to emerging markets. Emerging markets much more impacted. If you look at the fact that we do have a strengthening U.S. dollar, when you look at the makeup of the basket that makes up the U.S. dollar index, 65% of the basket is emerging market currencies. So as U.S. dollar moves up, it means emerging market currencies moving lower, and that is creating some inflation in emerging markets and is raising some credit risk issues. The only area globally you see increasing prices for credit default swaps are countries like Russia and Brazil, where the currency is starting to bite. And then when you look at the countries that are most associated with emerging markets, Canada and Australia, they continue to underperform. And to be clear, if you look at a correlation chart of the Canadian dollar versus commodity prices, very tightly correlated. If you look at emerging markets versus Canadian market, very tightly correlated. So I think it's not impossible that you continue to see the Canadian stock market underperform U.S., and together with emerging markets, they probably should be underweight in the portfolio, and it's probably exacerbated by the fact that Canadian dollar is likely to continue to be weak as well. Things that we're avoiding, we continue to avoid resources. There's all kinds of folks that continue to want to try and pick the bottoms in these things, and you're in a bull market, they are not participating. There's no use in guessing when they might work. Wait and see them begin to work. In general, I would say that sentiment continues to be too bullish, especially in Canada for these sectors. So here we are. It is third week in November. We are through the seasonally weakest period of the year. There is not likely to be a lot of news flow as we go through the rest of the year. I think certainly it's not impossible that you see some profit taking in the more frothy names, and we saw some of that today in some of the 3D printers. That's going to happen. You get short, sharp corrections in a bull market. So steady advances and short, sharp corrections that shake out investors. What we can say is any of the pullbacks we've seen in the last 3 to 4 months have been extremely shallow. For those that have been waiting for the magic 10% pullback, it has not come. And I think that they are the investors are beginning to get antsy and buy the dips earlier. Low volatility market is a constructive market. Really with that, I want to leave you with one thought. I may have mentioned this before, but we recently had a conversation with Adam Parker, who is the Chief Investment Strategist at Morgan Stanley. In Morgan Stanley's private bank, they administer $1.7 trillion on behalf of private investors. As of about 2 weeks ago, he told me that the average client at Morgan Stanley is 62 years old. The average account holds 18% cash, earning 0.24 of 1%, and over 50% in bonds, earning somewhere around 3%. Equity ownership is at multi-cycle lows. So there's always things to be concerned about. We've been through 13 up and down years in the U.S. and Canadian equity markets. Investors in general, I think, are gun-shy. But it may be that the pain trade is that interest rates stay lower longer than people expect, and that there is a lot of money that will, over time, work its way back to equities. This is without mentioning the significant under-ownership of equities and pension accounts. We continue to focus in dividend growth in the income portfolio. We're very pleased that from a return standpoint, returns have been strong over the last 12, 13 years with very low volatility. We think that makes a great base. We are encouraging people to take a harder look at the equity strategy. In the 1990s, this was a wonderful strategy to be in. And from 2000 to 2013, I think the equity strategy was somewhere around 9.5% a year over 13 years. So this is a strategy that can do well in a bunch of types of markets, and certainly I think it's in the right spots right now. With that, I'm happy to open it up to questions.